The Fed just cut interest rates again. And right now, millions of people are doing exactly the wrong thing with their money. They're leaving cash in accounts earning almost nothing. They're missing windows that won't stay open for long. And they have no idea the clock is already ticking. In this video, I'm going to show you exactly what this rate cut means for your money, your savings, your debt, your investments, and most importantly, the 4 moves you should make right now before everyone else figures it out. Let's get into it. First, let's quickly understand what's going on. The Federal Reserve, the most powerful financial institution in the world, just lowered its benchmark interest rate. This is now the 3rd rate cut since late 2025. The current target range sits between 3.50% and 3.75%. And experts at Morgan Stanley and BlackRock are projecting the rate will drop further to around 3.4% by the end of 2026. Now, why does this matter to you? Here's the simple version. The Fed's interest rate is like the heartbeat of the entire economy. When it goes down, borrowing money becomes cheaper. Mortgages, car loans, credit card debt, business loans, all of it gets less expensive. But, and this is the part most people completely miss, when rates go down, the interest you earn on your savings also goes down. So this is a game of 2 sides. Borrowers win, savers need to adapt, and the people who understand this shift and move quickly are the ones who come out ahead. Think about what happened the last time the Fed aggressively cut rates. Back in 2019, the Fed cut rates 3 times in quick succession. The investors who repositioned their portfolios during that window, they saw their net worth grow significantly before the pandemic even hit. The people who waited, they scrambled to catch up. And many never did. History is repeating itself right now, and you are watching it happen in real time. Let's talk about the bad news first. If you have money sitting in a regular savings account right now, you're already losing the game. The national average interest rate on savings accounts is just 0.39%. Checking accounts? Even worse, barely 0.07%. That means if you have $10,000 in a traditional bank account, you're earning about $39 a year. $39 for $10,000 sitting there. And here's the brutal part. With inflation still running above 2%, that money is actually losing purchasing power every single month. Now, with more rate cuts coming, those already tiny returns are going to fall even further. So what do you do? That's exactly what we're covering next. But first, let me show you just how bad this really gets. Let's say you have $50,000 saved up in a traditional savings account at 0.39%. You earn $195 a year. Meanwhile, inflation at 2.6% is quietly eating $1,300 of your purchasing power. You're not breaking even. You're losing $1,105 every single year without spending a single dollar. The bank is not your friend in a falling rate environment. They will lower your savings rate fast and lower your loan rates slow. That gap between what they charge borrowers and what they pay savers is how they make billions. Understanding this is the first step to protecting yourself. Here are the 4 moves that smart investors are making right now. Move number 1. Lock in high CD rates immediately. Certificates of deposit, or CDs, let you lock in today's interest rate for months or even years into the future, regardless of what the Fed does next. Right now, some of the best CDs are still offering between 4% and 4.5% annually, but that window is closing fast. Every time the Fed cuts rates, those CD offers get worse. So if you have money you won't need for 12 to 24 months, moving it into a high-yield CD right now is one of the smartest things you can do. Move number 2. Attack your high-interest debt. Here's something most people don't know. When the Fed cuts rates, credit card companies don't always pass those savings on to you. In fact, credit card rates have barely moved at all this year. The average is still above 20%. So while mortgage rates are falling, your credit card is still bleeding you dry. The smartest move: Use a 0% balance transfer card to buy yourself 12 to 21 months of interest-free breathing room. Then, attack that principal hard. Every dollar you pay off on a 20% interest card is like getting a guaranteed 20% return on your money. You won't find that anywhere else. Move number 3. Reassess your investments. With rates coming down, the investment landscape is shifting. Historically, when the Fed cuts rates in a stable economy, the stock market tends to perform well. BlackRock's analysts confirmed that large-cap equities have outperformed on average in the 12 months following previous rate cut cycles. But here's the key nuance. Money market funds, which many people use as safe cash holdings, are going to see their yields fall in line with Fed cuts. If you have a lot of cash parked in money market funds right now, it may be time to start shifting some of that into longer-term bonds or diversified ETFs before those money market yields drop significantly. Move number 4. Consider refinancing loans. With rates coming down, this is a golden window for anyone who took out loans when rates were high. Mortgages, auto loans, personal loans. If you locked in a rate of 7% or higher over the last 2 years, it's worth shopping around now. Even dropping 1 percentage point on a $300,000 mortgage saves you over $200 a month. That's $2,400 a year just from one phone call to your lender. Don't leave that money on the table. Now, before we talk about the big picture, let me warn you about the 3 biggest mistakes people make during a rate cut cycle, because knowing what not to do is just as important as knowing what to do. Mistake number 1. Chasing yield in the wrong places. When savings account rates fall, many people panic and throw money into high-risk assets chasing higher returns. Crypto, penny stocks, speculative ETFs. Don't do this. Rate cuts are not a signal to gamble. They are a signal to reposition, strategically, not emotionally. Stick with proven vehicles, CDs, treasury bonds, dividend, ETFs, index funds. Mistake number 2. Waiting for rates to bottom out before acting. This is one of the most common and costly mistakes in personal finance. People think, I'll wait until rates are at their lowest, then I'll refinance. But here's the reality. Nobody rings a bell at the bottom. By the time you know rates have hit the floor, the best CD offers are already gone. The refinancing window has already closed. The stock market has already priced in the cuts. You missed it. The time to act is not when it's obvious. The time to act is right now, when most people are still figuring out what's happening. Mistake number 3. Ignoring your emergency fund. This one is subtle, but important. In a falling rate environment, people get excited about investing and forget that the foundation of any financial plan is liquidity. Make sure you have 3 to 6 months of expenses in a high-yield savings account, not a traditional bank. A high-yield account still offering 4% plus while they last. Marcus by Goldman Sachs, Ally Bank, SoFi. These are currently still offering rates far above the national average. Lock that emergency fund in before those rates disappear too. Now, here's the thing. Most financial videos won't tell you. Rate cuts are not magic. They don't make bad financial habits good. They don't fix a portfolio with no diversification. They don't erase $30,000 in credit card debt overnight. What rate cuts do is create windows to lock in better rates, windows to refinance at better terms, windows to invest while valuations are still reasonable. But windows close. The people who act in the next few months will look back in 3 years and call it one of the best financial decisions they ever made. The people who wait, they'll wonder why they missed it. As one expert at Bank of America recently put it, unless inflation reignites, we expect 2 additional rate cuts in 2026. That means the window is open now, but it won't stay open forever. So let's recap everything we covered today. The Fed has now cut rates 3 times since 2025, and more cuts are coming. Your traditional savings account is quietly bleeding your money dry. And there are 4 moves smart investors are making right now. 1. Lock in high CD rates before they disappear. 2. Attack high-interest debt with a balanced transfer strategy. 3. Reassess money market holdings and shift toward longer-term assets. 4. Explore refinancing any loans you took out at higher rates. And the 3 mistakes to avoid. Don't chase risky yields out of panic. Don't wait for the perfect moment that never comes. And don't neglect your emergency fund in the process. Here's the thing about personal finance that nobody tells you when you're starting out. The biggest wealth builders in history weren't the ones who picked the best stocks. They weren't the ones who timed the market perfectly. They were the ones who showed up consistently or when others were confused or paralyzed. Right now, most people are confused about what these rate cuts mean. You are not one of them anymore. You have the knowledge. The only question left is, what will you do with it? If this video helped you understand what's happening with your money, hit that like button. It genuinely helps this channel reach more people who need this information. Subscribe, because every week we break down the economic shifts that actually impact your wallet.